Happy New Year, everybody. We are going to talk about some of our favorite stocks for 2024 and also stocks that we think might have kind of overreached. So, Tyler Crowe is joining me today. Tyler is an expert analyst from the Motley Fool. And before we get started, please take a minute, click subscribe, and check out the message you see on your screen from our sponsor, the Motley Fool. You get the top 10 stocks to buy right now, and it's the best way to support this work we're doing. So, Tyler, I know before we recorded, we were talking about a stock that you think people should sell and what you think they should do with the proceeds if they want to kind of stay invested with the money. And I was kind of blown away because I hadn't checked their chart in a while and I didn't realize how much they had risen in 2023. So, first of all, what stock are you talking about? Why has it done so well? And why do you think people should get rid of it?
So the company that I mentioned, and then kind of really, it took me aback too. I even started coughing. It was so surprising. But Carvana was up 890% over the past year, and this is one of those situations where it's not because the company was doing great. It was because everyone was so scared that it was almost insolvent that in January 2023, this thing was basically priced for bankruptcy, and it didn't go into bankruptcy. So let's just back up the chart just a little bit further. And if we go back over the past 3 years, it's still down 80%, which gives you an idea of like how bad things have been for Carvana over the long haul. Now, the reason things have gotten better is because we just did a previous video on Open Door and like what they have done to try to right size the business, which has been kind of, sell down sell down inventory in order to kind of raise cash and pay down debt. And Carvana has kind of more or less done the same thing. It has paid down some debt by reducing its inventory. Its total inventory of vehicles has dropped about $1.5 billion over the past year because it's been selling, but not necessarily buying as many as it has. Now, we could say that's a slowdown in the used car market. Maybe that's a part of it, but this is a deliberate decision to focus on improving profitability, which means you're not just going to throw silly numbers at people who want to sell their car just because you want to take market share, which was what Carvana had previously done. So, this is just one of those things where it's like, if you had done some special situation where in like January, you're like, I don't think Carvana is going to go bankrupt and decided to invest in it. Congratulations, you made one of probably the best short-term calls on the market today, and you're up almost 900%. So fantastic. But in all honesty, I don't necessarily see the business improving so much that it's going to continue to keep doing better and better and better. It's still dealing with a very large debt load, and it's if you're winding down your inventory, you're not a growing business. Year over year sales are down 20%, and so you look at things like that and you say, well, it just doesn't quite add up to what to me looks like long-term success for a business. It has a lot of the problems that we discussed with Open Door, and I don't necessarily know if it's going to get any better.
Yeah, I just don't know if I'm a fan of their business model at all. I mean, I don't know if it's a good business or the business has turned around more than they just avoided bankruptcy. Because this is a business that made a lot of sense, say, during the early days of the COVID pandemic, when you literally couldn't test drive a car or literally couldn't have people come to your house to, give them a test drive if you wanted to sell your car. It made a lot more sense during those times. And it was a big COVID beneficiary if you look at the stock chart. But like you said, I think we talked about you sold it to a company, sold a car to a company similar to Carvana and couldn't believe what they paid for it. And a lot of people said, I saw a lot of just anecdotal posts on Twitter. I sold my, 2005 Dodge Ram to Carvana for $25,000 or, something to that effect. And they were overpaying for vehicles. And like we discussed with Open Door, did they do irreparable damage to the balance sheet? Maybe.
Yeah, and to that same degree, like it's easy to buy a lot of inventory when debt is really cheap, but all of a sudden when you have to, take out loans at 6, 7, 8%, all of a sudden that's just not quite as easy. So all in all, it's just I I really still can't warm up to this. I don't think it's done enough to turn it around.
So what do you think investors should look at instead?
So I, I'm actually going to stay with the auto dealership kind of business, and I'm going to suggest people take a look at Lithium Motors. Lithium Motors is actually a combination of the traditional dealership model, along with they have built their own Carvana competitor internally. It's called Driveway. And in the past quarter, they had about 3.25 million monthly unique visitors in the quarter. So it's not a small website. It's generating traffic, and it it, it seems to be getting headway and kind of slowly eating away at Carvana's first mover advantage. One of the benefits that Alithia has over Carvana is that Carvana started as a website, and then all of a sudden they have to build infrastructure and servicing facilities and warehouses and all of the other things that you have to do to hold inventory of vehicles. Lithium Motors has this. It has used car lots. It has service centers. Service centers are, by the way, one of the most profitable points of a dealership. So if you own an automotive dealership, you want to be involved in used cars and in sales and in service because they're the highest margins. Your actual new car sales are not really the most like profitable thing. They kind of get people in the door. And so what attracts me to this is they have taken their infrastructure of a nationwide dealership model and applied a Carvana asset light, kind of taking those customer demands of like, I don't want to hassle with or haggle with a salesman. I just want to buy online. Excuse me, by the price that they say that is posted. And so it makes much more sense. It's taking an existing business and slapping the software on top of it and allowing the infrastructure around it to become more profitable by utilizing multiple channels of sales. And on top of the fact that it's, doing this, it's also a much more profitable business. This business has been around for a long, long time. It's up almost 400% over the past 10 years in terms of total return, and yet it's still trading for a trailing price to earnings ratio of only 8.2 times and about 1.4 times total book value. So in terms of looking at a cheap business that is doing a lot of the things that Carvana purports itself to do, I think Lithium Motors is something that investors should really check out.
Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.